Alright, in this video we're going to be discussing the concept of materiality as it relates to financial statement audits under generally accepted auditing standards, and that comes in section 200.07. Now this is a very high level explanation of materiality, and discussion of materiality in more detail is in AUC section 320. So let's take a look at this particular paragraph here piece by piece. So we see here the auditor is going to consider materiality at the planning and the performing stage of the audit. And so at the beginning of the audit, the auditor will decide materiality levels that might be appropriate during the planning stage. That way they can determine the procedures necessary to hone in on those particular risks that are important and those that are not. Also during performing the audit, understanding the levels of materiality and where the largest risks are. And also at the end of the audit, when the auditor has accumulated all of the identified misstatements, both corrected and uncorrected, to determine how do those misstatements affect the overall financial statements when accumulated together. So having said that, they sort of define materiality here by saying that a misstatement is considered material if individually or in the aggregate the financial statement user could reasonably be expected to be influenced by those misstatements when they're making economic decisions related to those financial statements. And different types of financial statement users, for instance, maybe investors or regulatory entities, insurance companies and such, may find different aspects of the financial statements to be important to them. And so that's why it takes significant judgments by the auditor to understand the circumstances of the financial statement users, and also to consider the qualitative as well as the quantitative aspects of the accounts and materiality of those. And so depending on the auditor's perception of the needs of the financial statement user, he needs to consider the size or the nature of the misstatements that might influence their economic decisions. And so when the audit's all said and done, the auditor's opinion addresses the financial statements as a whole. So it's not one particular account or assertion or anything like that. It's do the financial statements as a whole reflect a true and accurate representation of the financial statements under the applicable financial reporting framework. So that's why the auditor needs to take consideration of the misstatements when aggregated together. That way he can develop his opinion of whether the financial statements as a whole are accurate. And so having said that, the auditor does not have a responsibility to plan or perform the audit to obtain reasonable assurance that misstatements that are not material to the financial statements as a whole are detected. So there may be misstatements throughout the financial statements, but if they're not considered to be material to the financial statements as a whole, the auditor has no responsibility to detect those or to alter his opinion.